top 2020 trade, oil or copper or soybeans, the top performers in 2019. Will they be able to hold on to their number one spot next year? Sea change. New shipping rules take effect in January. Is the world prepared? And clean fuel planes. We speak to Jeremy Baines, Neste U.S. CEO, on how using biofuels for planes will be the next big growth driver. I'm Alix and welcome to Bloomberg Commodities Edge. 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, let's kick it off with Spot On. It's our take on the big story. And today, our spotlight is on the top 2019 trades and how they're shaping up for 2020. On the top, you got nickel, you got crude and coffee. On the downside, though, we have things like natural gas, cotton, as well as steel rebar. And we have you covered from all of those angles. Joining me, Mike McGlone of Bloomberg Intelligence, Tina Davis, managing editor of Energy and Commodities, Bloomberg Ag reporter Isis Almeida in Chicago, and Everett Millman, precious metals specialist at Gainesville Coins. Let's start with Mike on copper. We've seen this really strong rally. Mike, can we continue?
Unlikely, unfortunately. I'm really worried about the divergent weakness in copper. I mean, you have crude oil up 30%. You have the S&P 500 up 30% this year. Copper's just kind of inching up lately. It's being dragged along. If we just get a little mean reversion in those other markets, copper's got a problem. The key issue is PMI, global's PMI, China PMI, it really subdued. You have to just expect it to completely reverse right away, and I don't think that's going to happen. So to me, copper's stuck in a range, and the bias, I'm still fearful, is down.
Well, let's talk about that, because if you take a look at, say, copper versus PMI, for China, what is the correlation? How specific is it?
It's very high. If you look back the last 20 years, it's close to 0.90. I mean, that's a very high R squared. China PMI, and then that's also a key thing about copper, which is unique. It's very highly correlated to the overall commodity market. Typically, it was crude oil, but the last 10 years, copper has been the strongest companion. So I think it's the market looking forward to decarbonization, technology advancing, and copper should do well in that space, but crude oil has been kind of pushed to the wayside a little bit.
Good point. Thank you so much, Bloomberg's Mike McGlone. Now we want to turn to oil. Now, Tina, commodity forecasters are looking for muted oil prices in the first half, but then really picking up in 2021 and 2022. What do you hear on the street?
I think 2020 is going to be fairly muted. We're not expecting any huge fireworks at this point. And basically what the market is waiting to see is how much the OPEC production quotas will actually help drain down some of the excess inventory that we've seen that's sort of built up and then obviously caused some depressed prices this year. And then we're looking at sort of the second half of 2020. It might be slightly more exciting as we see those inventories drain down and the potential for a little bit more action in the price.
On the flip side, if you take a look at, say, CCRV, which is the curve function on the Bloomberg, you can just see longer-term depressed prices. Citi just had a note out that talked about how a lot of hedging happened when you saw the back-end kind of rally. Is this a good predictor of where we're going to go longer term?
Right. I mean, the market is in backwardation now, which is sort of where it should be, ideally. But if you look at this is not obviously a prediction of what prices will be. It's more where they are trading right now for those contracts. So what the graph is reflecting is obviously the sort of near-term concerns about both supply and demand. And then if you go further out, sort of 5 years out, then we're talking about the potential for shale growth in the U.S. to have stalled out and what happens next.
Hence the potential price spike. All right, Tina Davis, thank you very much. Appreciate it. Now I want to get the outlook for agricultural. So here is a note that came from one of the big investment banks. A plausible bullish scenario might allow for $31 to $32 billion of U.S. ag exports to China over the next 12 months. That's up almost 35% from 2017 levels, but well below the White House ask. With us now from Chicago is Isis Almeida. That's the big question. Are we going to see the big boost to prices as China comes in and buys on that phase one trade deal?
I think that's really going to depend on whether China decides to follow market-oriented purchases or not. So far, they've been saying that they are only going to buy from the U.S. if the price is right. So that makes it a challenging ask to get to 40 or 50 billion. And I think, therefore, there's a lot of skepticism out there where people think, 32, 33 is a lot more feasible. So far, we're still waiting to hear from China. There's still tariffs on a lot of different products. So soybeans, for instance, still has tariffs on. How is China going to manage these imports if the tariffs remain on? So it's really a wait-and-see game, and that's why I think the reaction to phase one deal has been somewhat muted, with prices for most commodities, at least most agricultural commodities, up 1% to 2% only.
In reality, Isis, is there one commodity that's really best positioned to take advantage of that phase one trade deal in the ag space?
Well, I would say hogs. I mean, definitely pork. We know that China has African swine fever, and that has killed 40% of its herd. We know China is the world's largest pork consumer, and it's going to need pork. And I think that's why we've already seen the move that China took to bring down tariffs on pork for next year, so to make it a lot easier. And we also have the Lunar New Year coming up at the end of January, and that's when the Chinese eat a lot of pork, so they need to make sure the supply is there.
Isis, thank you so much. Bloomberg's Isis Alameda. And now I want to welcome Everett Millman, precious metal specialist at Gainesville Coins. No doubt you know you're going to be talking about gold. So we hit all the other commodity classes. I'm hearing a lot of like $18,000, $16,000, $2,000 calls for gold next year. What do you see?
Well, I think everything is moving in a bullish direction, partly because we're seeing signs that we're late in this economic cycle. Debt and leverage are rather high globally. If you look at household debt is at record highs, corporate debt is at all-time highs, and sovereign debt to GDP ratios are fairly elevated. All of that makes gold the kind of stabilizer, that safe haven asset that not only investors, but institutional investors like central banks are turning to because it seems to be late in this economic cycle.
Do you have a sense of the type of investors that are in now and the new type of investors that need to come in to really help support that higher gold price?
It's a good point because hedge funds and central banks have been the main buyers right now, but the retail demand, retail investors, mom and pops, have not really been jumping into gold or any of the precious metals yet. So I think if we see prices elevate back to about $14.90 an ounce, $1,500 an ounce, and there's more interest, that will drive prices higher when that retail demand comes in.
Right, and then on the flip side, do we have price-sensitive physical buyers in China and India at, say, $1,500?
Absolutely. We saw that earlier this summer, that when gold prices were seasonally elevated, usually gold is low during the summer, and it was rather high, obviously, this year, imports into India almost collapsed. And there was a bit of a substitution effect where silver imports into India were much higher. So that does seem to, we have seen some price elasticity with gold overseas in India and China, and that may reverse if we have some consolidation for the Q1 of next year.
So does that mean that we have a natural cap at around $1,600, or what's it going to take to get to like an $18,000, $2,000 scenario in your point of view?
Oh, I think that geopolitics is going to loom largely in that respect. Unless we get maybe an escalation in geopolitical tensions or the trade war kind of heats up again, if the deal falls through, that could drive prices higher. But I think you're right that 1,600 is probably a safe cap, and that we'll see gradual growth towards that point next year.
And what about gold stocks? Like, what does that then mean for the underlying equities?
Well, the miners will do well in a high price environment, but we have to keep in mind that new projects in the gold mining industry generally take 5-7 years to get online. So it could be a gradual process. We may not see miners outperform until a little bit further down the road.
Well, and to that question then, we talked a lot about how gold's going to be demand driven. A lot of the move we saw in other commodities has actually been supply driven. What's the supply picture when it comes to gold?
Well, actually, gold is fairly abundant right now. Production has been steady. Every year, it's about 3,000 tons added to the supply, and gold has a very high stock-to-flow ratio. So the existing stockpile of gold really never goes anywhere, unlike other commodities. So I think that means it'll probably be more stable, and it doesn't follow the exact same pattern like we see with copper or silver that get used up by industry very regularly.
Well, fair. So if we see like a 5 to 7 years until you get like a mine to come online, and we have seen consolidation in the space, is there going to be some kind of supply gap though in the middle, or just means the recycling market, for example, is going to pick up pretty well?
You said it perfectly. I think the recycling will kind of step in and take care of that, because that's generally what happens with gold. So much of it trades hands. There really isn't any of it that gets used up or destroyed. So the supply concerns, I think, are something we can kind of ignore for now.
All right, Everett, thank you very much. Really appreciate the outlook. Everett Millman of Gainesville Coins. And what happens in the commodity sector can directly affect growth. So Dallas Reserve President Robert Kaplan told Bloomberg he thinks energy capex next year is going to suffer.
CapEx for the energy business, we think this year has been down 5 to 10%. We think it'll be down 15% next year because of the lower price of oil and profitability challenges and capital discipline.
I'm Alix. This is Bloomberg Commodities Edge. Time now for the data dig, where we delve deep into the market trends of the week. So first up, you have China and U.S. are inching towards a trade deal, and I wanted to take a look at some of the losers. So this chart shows soybean exports from Brazil and Argentina. The green bars are Brazil. They were the big winners in a trade war. So what happens if you have the China buying more from the U.S.? These guys could become the big losers. So from the losers to the winners could be nut producers. So you could see almond, cashews, pecans, maybe some of the easiest nuts to crack in order for China to fulfill its pledge to buy more U.S. agricultural products. So watch this chart here. China could purchase as much as $2.5 billion worth of American nuts a year as part of that phase one trade deal. That's more than it's expected to spend on key American produce like corn, wheat, and even pork. And it is a defining moment in the history of oil refining and shipping industries. So January 1st, vessels will have to use fuel with less sulfur in it. And this is how it's playing out in the market. You have weak, high sulfur fuel oil prices all over the world. You're looking at Singapore, U.S. Gulf, as well as Northwest Europe crack spreads against the Brent price. All have been turning much lower. Yeah, there's been a little bounce recently, but all have been lower as IMO 2020 kicks in and you have more demand for the low sulfur fuel oil. Now let's get into the ring. It is these new IMO rules versus the shipping industry. Some already say these rules are not enough. A group of ship owners have announced plans for a $5 billion fund to design zero-emissions vessels. They say $2 should be levied on every ton of ship's fuel to support research into clean engines. Earlier, I spoke with Guy Platten, the Secretary General of the International Chamber of Shipping, which is leading the movement.
Oil, it's got its faults in terms of the carbon intensity, but it's a very high calorific fuel. It's a good fuel to burn. So we need to find an alternative. And is that hydrogen? Is that ammonia? Electric in terms of batteries, well, we know that's got a place perhaps for the shorter trips. But what do we do for transoceanic voyages? So this research really needs to be accelerated. There are nascent ideas out there, there's nascent technology, but we've got to produce it at scale in order to actually put it into ships for the early 2030s. So that's why we really must now focus on this research and development and why we're proposing this fund.
Well, how long do you think it would take once you come up with any sort of good ideas? Because I'm just thinking about IMO 2020. I mean, implemented in 2008, and just now are we actually going to see the fruits of this?
Indeed, so it comes into force in January, and that's not been without its problems. But we recognise there's a crisis here now. Ship owners around the world recognise they need to do their bit. And so we believe if we can get this fund up and running, if we can get approval from the member states that form part of the International Maritime Organization, because we're going to have to mandate this, we can get this fund up and running by 2023, and we can start doing this research at scale, which will enable us to achieve these very, very challenging and daunting targets.
Are countries into this?
It's, the feedback we've had from some member states, very informally at this stage, because we're only just launching our proposal, has been positive. Certainly the shipping community is completely behind this. We've got all the international associations absolutely at one. We recognise we need to do something. We hope our proposal will find favour with the member states and we can get this through, because really time is of the essence.
Why isn't IMO 2020, say, good enough? Let's start there. Let's work on enforcement, implementation, etc.
So 2020 is addressing a particular issue, which is air quality. So it's reduced the sulphur in the fuel in order to improve the air quality for coastal communities and the like. So that's a very important development. But so this is something that on steroids, really, because we're looking at changing the entire fuel. We're calling it the fourth propulsion revolution. So IMO 2020 is a challenge. It's being addressed, but this is a massive challenge we've got facing us when we're actually going to take oil out of the equation and have alternative fuels.
So in your estimation, just on the short term for IMO 2020, there's two questions. One, are shippers prepared? And somewhat maybe more importantly, are countries actually prepared to enforce these rules?
We hope there'll be a level playing field. That's what the indications we've got. I think it's important for shipping companies to know they're going to be treated equally wherever they go. Our concern is about the safety and availability of the fuels from the 1st of January. They're taking a lot of blends and mixes of those fuels. So, we hope it'll all be smooth and in transition. But clearly we have some fears, and we're only, 3 weeks away from the implementation date. So we're watching it very, very closely.
So in terms of, though, what's keeping them up at night for IMO 2020, I mean, if you don't have countries participating or they're not going to actually really enforce, I mean, that creates a lot of difficulties with shippers. None the least is that if they have shipping compliant fuel, they get into port and then they can't actually replenish, say, their low sulfur fuel oil, for example. How do you sense that we're going to see the first 6 months of this transition?
So we've also a pragmatic sort of introduction to all of this, so people to realise we do have various systems in place if a ship owner, with using all best endeavours, cannot obtain the right kind of fuel. We have what's called a fuel oil non-availability report. So there's various provisions within the regulations that allow for that. But we are calling on some pragmatic implementation, so that there's some understanding that ship owners are using their best endeavours to comply with the regulations.
That was my interview with Guy Platten, Secretary General of the International Chamber of Shipping. Well, coming up on the program, Jeremy Baines, president of Neste US, explains how biofuels could help curb CO2 emissions and PADA's bottom line. Next on Bloomberg Commodities Edge. I'm Alix. This is Bloomberg Commodities Edge. Let's turn now to Commodity in Chief, where we focus on one executive in the commodity world, and today it's Jeremy Baines from Neste. First, let's take a closer look at his company.
The world needs to spend $50 trillion by 2050 to cut emissions enough to meet the Paris Agreement's goal of curbing global warming. Here's where the world should spend it. Hydrogen, gas to fuel power generation, industrials, cars, and heat homes. Price tag, $19.4 trillion. EVs, cars make up 7% of greenhouse gas emissions. Price tag, $11 trillion. Carbon capture and storage, cost about $700 million to capture 1 million tons of carbon a year. Price tag, if you add storage, $2.5 trillion. Renewables, needs to deliver about 80% of global power by 2050. Price tag, $14 trillion. And biofuels, fuel produced from waste and residue like cooking oil and food animal waste. Price tag, $2.7 trillion. Enter Neste, a Finnish company trying to win with biofuels. Its renewable unit makes up just 20% of revenue, but almost 70% of adjusted operating income. And it sees its next growth opportunity as planes. CO2 emissions from aviation is on the rise, and there's pressure to tax jet fuel, and biofuel adoption is slow. Costs are high, and there is limited supply. Neste is trying to change that. It has 15 MOUs with airlines and airports and is expanding its facility in Singapore to increase production to 340 million gallons by mid-2022. The company sees jet fuel growing 2 to 3% a year, and Neste wants to be at the clean fuel center of that.
I recently caught up with Jeremy Baines and asked how the process worked.
It starts with the feedstock. You need to be able to source the right feedstock at competitive prices. You need to be able to pre-treat it in such a way that you can actually put it into our renewable diesel refineries. And then once you have the renewable diesel, it needs to go to the right market. You need to sell it in the right way, it needs to be transported. So there's a very long supply chain, if you want, that needs to be managed. And that's really where Neste has been able to excel over the last couple of years, is to really, in a sense, to crack that formula, how to do that in an efficient manner. And that's what has really been driving the margins on the renewable side.
So when you walk it forward, what's the growth rate look like? Are you going to grow at the same kind of rate you have in the past couple years here in the U.S.? And if so, where are the pockets of demand?
So the renewable business, I think today for Neste, there's probably more demand than there's supply. We have announced our Singapore expansion. We're looking to have that online in 2022. That will give us the ability to grow certain markets further. And the US is one of those markets that we're looking at.
What's the next fuel we're going to all have to pay attention to?
Well, I think sustainable aviation fuel is clearly an important fuel that's coming along. Today there's very little of that available. The aviation industry has got a very strong commitment to decarbonize, and sustainable aviation fuel will form an important part of that. So that to us is one important one. We're also looking at the circular economy concepts, like on recycled plastic, how that can be used either to convert it into conventional road fuels, or even brought back to new feed for new plastics. So there are lots of exciting spaces in the renewable business to look at.
When you talk about aviation fuel, do the planes have to be fitted with a different kind of fuel tank for that to happen?
Well, I think that's one of the real key things about sustainable aviation fuel, is that it works in existing infrastructure. It works in existing engines. There's no additional investment that needs to be made. The only thing you need to do is drop it into the tank and off you fly.
So what's the holdup?
Well, this is a nascent industry. It is still growing. 34 million gallons is still a very small amount. Neste, or like our competitors, we don't have the economics of scale.
Talk a little bit about where all of this sits within the broader energy transition.
I think it's part of the solution. If you look at road transportation, there's a big need for electrification in the light duty, maybe the medium duty, but it's in the harder to abate industries, like the aviation fuel, like heavy duty road transportation, that we need to have these sustainable liquid renewable fuels. They are the only ones today providing the energy density to really compete. And SAF is the only fuel that will power planes and reduce emissions.
That was my interview with Jeremy Baines of Neste. Since then, the stock has rallied after reinstatement of a blender's tax credit here in the U.S. And they go by many names: wild hogs, razorbacks, feral pigs, whatever your moniker. The wildly destructive invasive species who've long burrowed in the South are now set to invade northern U.S. states and Canada. And we're not talking about cute and cuddly little piggies going to market. As it turns out, feral hogs are really scary. The pigs can weigh hundreds of pounds and they can destroy everything in their sights, from crops to military planes. It's estimated the hogs can cause up to $2.5 billion in damage. And should the swines advance, wildlife officials are planning an air assault, hunting the pigs from planes with high-tech equipment like night vision goggles and thermal imaging scopes. That's no hogwash. That does it for Bloomberg Commodities Edge. Happy holidays, everybody. Make sure to catch us every Thursday at 1 p.m. New York time. This is Bloomberg.